We all know that crypto never sleeps. And in this upside-down market, monsters are everywhere. But by learning how to negotiate the Demogorgon, you can still make money. In today's episode, we'll introduce you to one of the scariest creatures haunting your favorite exchanges, the funding rate.
Hi, I'm Christopher German, your host broadcasting from the wilds of Washington State. In this episode, we will look at the funding rate. But I have to warn you, this is some scary stuff. And if you're not careful, it can do you one worse than eating your face off. It can empty your wallet. So this is for educational and informational purposes only. And if you want real financial advice, find a good financial advisor because I am just not it. But smash that subscribe button and buckle yourself in because we're heading to the upside down of crypto and it could be a bumpy ride. Now, to make profit, exchanges provide marginalized products to their users. One of them is called perpetual futures. They're different from futures in traditional stock exchanges, but isn't everything in crypto? The main difference is perpetual futures don't have expiration dates. They expire when you liquidate and take your profit. The question you're asking yourself now probably is, how is the price of a coin or the spot price different from that of the perpetual futures price or the futures price? This is a volatile market after all. How do I keep the prices of futures and spot prices from going haywire? Well, let's tackle this one piece at a time, shall we? The thing that holds perpetual futures to the ground and keeps them from deviating too far from the spot price is the funding rate. And exchanges all try to keep their funding rates in line with the two biggies, Binance and FTX. Now, suppose you are long on Bitcoin for $100,000 in perpetual futures, and various others like you have taken a long position as well. Also, let's assume there are very few people on the short side. To keep the futures price equal to the spot price, long side traders pay a percentage in the form of a fee to the short side traders. This fee keeps the price in check. This is the simplest definition of the funding rate without indulging in a bunch of jargon. Every exchange has to calculate the funding rate of each crypto, and some calculate it on an hourly basis, some do it every 4 hours, while some calculate it every 8 hours. Here's an example of funding rates from various exchanges. Now, let's do a little of our own calculation, shall we? Suppose the funding rate on your favorite exchange is 0.2%. You invest $10,000 and you're going long. 10,000 times 0.2 is $20. Since it's a positive rate, the long traders pay the short traders. The funding rate has two major factors, the interest rate and the premium. The interest rate is fixed for every exchange. The premium or fee paid is what is used primarily to calculate that rate. For example, Bitfinex may have ranges between negative 0.5% to 0.05% in one day, while Binance calculates its funding rate at 0.03% on a daily basis. Now let's look at a postmortem where we all heard about. Terra wiped out approximately $60 billion in investor money and sat on the bottom for the month of May. During their galactic crash landing, there was high volatility in their coin Luna, which had the usual and customary difference of approximately $5 between the futures price and the spot price. On May 12th, when Terra was hitting the skids, the funding rate of Luna saw huge volatility. Meanwhile, the premium of Luna also observed a spike for the short traders as the long side traders pulled out, seeing blood in the water. If you were one of those poor souls who were part of the Luna bloodletting, the good news is, as of June 1st of this year, the coin did show signs of life and with less volatility in the funding rate. But that's a story you're going to want to tell your grandkids down the line. The takeaway is the funding rate helps you predict prices. A positive funding rate implies traders are bullish and prices will go up, while a negative funding rate implies traders are bearish and prices will likely drop. They went that way negative on May 12th in the case of Luna. Now let's look at the other major news story of the year so far. Here's a chart on funding rates in green and red of Bitcoin, along with the price, which is plotted in yellow. As you can see, the price was stable in May and went way down in June, indicating a prolonged bearish market. By analyzing the option interest market and looking at historical trends in the funding rate, you can get a reasonable understanding of where the price asset will go. If you're still with me, and I hope you are, let me show you how to use the funding rate to make bank. Here's the first way. Suppose you have $10,000 in your pocket. You're on FTX and you want to trade on Atom, whose funding rate is 0.05%. The rate is settled 3 times a day. Let's say you keep $5,000 in your spot account and transfer the rest into your futures account. Let's also say the price of Atom is currently $10. Let's say you buy 500 Atom on spot and short 500 Atom on the future side with a 1x leverage. You can pick your leverage based on your appetite for risk, but remember, this is a blood sport. And big risks can lead to bigger failures. But if you trade on both the long and short sides, you can mitigate some of that risk. At the end of the day, if the funding rate remains the same, you close your position, you could realize a $250 profit on the day. Follow me here. 500 shares times $10 each times 0.05% equals $250. Charges on the exchange could cut into your profit, and if the funding rate goes below, you could see more profit from arbitrage, but that is just another show that I'm going to get to down the line. Imagine if you do this for 365 days in a perfect world, then 0.05 times 3 times 365 equals 55%. You could get an annualized return of 55% or $91,250. Not too bad for a yearly income, is it? Here's another way. Find a crypto that has different funding rates on 2 different exchanges. For example, if AXS has a funding rate of negative 0.225% on OKEx and Binance has it at 0.01%, go long on AXS for 5,000 on OKEx and go short 5,000 on Binance. Since the Binance rate is so close to 0 and the OKEx rate is so far below 0, the funding rate will go negative when the exchange reconciles. And when the funding rate on the exchange is reconciled, long pays short on negative rates, bulbs your uncle, your Binance position pays off. This method is all about timing though, and you might have some difficulty getting it right on the first few tries, but returns are potentially there, and the bigger the variation in the funding rates between exchanges, the larger the returns. So, is the Demogorgon of crypto upside down really that bad? The funding rate can be as scary as any mythical beast from the underworld, including Vecna. After all, it was designed by the people who want crypto to take over the world, and they want to entice investors to buy crypto derivatives. But this is the upside down, and there be monsters here. So trade wisely, my friend. I'm Chris German. Thanks for watching the Crypto Nightly News Halloween edition. And remember to annihilate that subscribe button so you can see all the episodes as we get them out. We'll see you next time. Happy Halloween. Thanks for watching. Bye.